Welcome back to ICT Trading Concept, friends. How are you all? It's midnight over here in Bangladesh, and I just sit to make the video, which is called the first fair lookup entry, or the entry where you don't need the market structure sheet. So, in this model, if you watch until the end, I believe that you will understand a lot of precision about the ICT concepts and where you really don't need to depend on the market structure sheet. I know it's little hard to believe, but yeah, it's working. I'm showing it to you almost every day in my life. But over here, I'm gonna make you clear about the rules and when you should look for the first fair lookup entry. It will be absolutely perfect or clear by that video. Okay, guys. So let's go to the video. First, I will go with the drawings. I love these drawings now these days. So over here, I'm gonna mark this as my last fair lookup. Okay, so this is the last fair lookup from 1 minute chart, not any other time frame, as my execution is going to happen from 1 minute chart. So I need this fair lookup from 1 minute chart, no other fair chart. This is the last fair lookup. This is the entry fair lookup. Now think price actually came. Maybe it came until the entry fair lookup or the last fair lookup. Any of this fair lookup is valid for building this model. So I'll go with the entry fair lookup, but if it come last fair lookup, it's also valid. Price come here, then it went lower. Okay, so it actually do this type of things. It went lower, maybe it went so far, then it went higher again, little higher, then finally it come back again around that area. Okay, around this area. Here, market has taken all of these highs. Every high has to be taken, and you know, not a shallow run. It has to be taken by the body. Okay, that means every single high has to be taken by that high. Then market will make the fair value gap over here, which is called the first fair value gap. You will take that entry and then the target. First thing first, it has to trade the entry fair value gap. Then there has to be lot of highs or maybe single highs, whatever it is. But when market will come back again at that area, it can't take the highest high. So this is my highest high. This high, it can't take the highest high, but it has to take all other highs. There can't be a single swing high that is not taken by that swing high. Only after that this entry will be valid. Okay, this high has to be taken by body, not by wicks. If it is taken by wicks, then I will call it as a shallow run, and I'm not gonna look for the first fair lookup entry where I really don't need the market structure sheet. Okay. After doing this, the first fair lookup to that leg, this leg here, the first fair lookup is going to be my entry. Okay, that is called the first fair lookup where you don't need the market structure sheet. So I'm gonna mark it as my first fair lookup. Don't worry guys, I will show it to you to my chart and I will show that I actually take entry over there. Okay, I actually use this first fair lookup. If you already watched my live, you have seen that a lot of time, but yeah, still I'm gonna show it to you. Okay, so here when this candle will go, market come here, take all of these highs, fail to take that high. This high doesn't need to trade that entry fair value gap, but this high has to trade either the entry fair value gap from previous price action or the last fair value gap from previous price action. This high. Okay, but this high doesn't need to trade that entry fair value gap one more time. It can be below that entry fair value gap, but the rules is it has to trade or it has to take all of these highs. That is the only requirement I need to say. Again, if you get an SMT with even S&P or Dow, that is more good. It will be more perfect. If you don't get the SMT with even S&P or the Dow, still it's valid. Okay, but I'm just talking about the best example. In best example, you will get the SMT. Okay, trust me, you will get the SMT, but you don't need that. If you get it, it's better. If you don't get it, just let it go. Here it has to take, again, it has to take all of the highs, but it will fail to take that highest high. Okay, then the first fair value gap over here, you will look at that area. That will be a first fair value gap. If you see, this first fair value gap is broken by one candle. then you will wait to retrace that first fair value gap. But if you see, it takes a lot of candle, maybe more than one candle, okay, to break the first fair value gap. Body close has to happen below this first fair value gap, then it will be valid, okay. If it takes more candle, then you don't need to wait to retrace. When the first candle will close below this first fair value gap, you will take your entry over there. But if it is closed by one candle, this first fair value gap is closed by one candle, you will immediately wait to retrace that fair value gap, then you will take your entry. Now, here's the part where will be your target. Your target has to be the entry fair value gap over here. For example, just for example, okay, you saw there is a last fair value gap, so I'm gonna mark it that is my last fair value gap, and over here, this is my first entry fair value gap. Okay, your target has to be the entry fair value gap. It's not breakable. You have to follow this rule. This entry fair value gap will be your target. If you have more than one contract, then you can take a partial when it will tap that entry fair value gap, and you can go your rest contract until the liquidity. Maybe there is some kind of relatively equal loss. So you can go toward that liquidity if you have more than one contract. If you have one contract only, you will close your trade around that entry fair value gap. Now, if your entry is here and your entry fair value gap is from that leg, okay, your entry fair value gap is over here. That means your entry here, your target over here. If it is very small, for example, it's maybe 500. In that type of situation, you will hold your trade until the liquidity. But in this type of case, your stop loss has to be broken. I mean, not broken actually, I'm sorry. Your stop loss has to be in the break even. Okay, so something like this. Maybe you target over here your stop loss first. I will talk about the stop loss where you are going to put your stop loss. But whatever your stop loss is, maybe you hold until here. When market will come here to that entry fair value gap, your stop loss has to be to the break even. Okay, when it will be in the entry fair value gap, your stop loss has to be in the break even. Now, when you will take your first time you will take your entry, where will be your stop loss? Your stop loss will be above the consequent investment of that week. There will be a week you have to put your stop loss above the 50% of that week. The best case scenario is you can put your stop loss above the high. But if you see a very long week, then you can go for the 50%, and you will believe that market is not going to reach until the 50%. So you are going to put your stop loss above the 50%. Don't worry, brother. I'm going to the market or the chart, so you will understand what I mean by here. Okay, everything will be clear over there. Just first let me clear all the rules. Here, this is the last fair value gap, this is the entry fair value gap from 1 minute chart from previous price action. Then market actually came here to that entry fair value gap, and your bias is bearish. You are thinking that market is going to fall. You saw market came here and it was just doing so many swing high. Finally, market come here, it has taken all of these highs. Every single high has been taken by body, but it failed to take that extreme high or the highest high. Then you will start to look for the first fair value gap over here. When the candle will close below the first fair value gap, you will take your entry over there. It will depend two type of situation. Either the breaking of this first fair value gap is going to happen by one candle, you will wait to retrace. If it takes more than one candle, then the first candle will close below the first fair value gap, you will take your entry over there. You don't need to wait to retest that fair value gap. Your stop loss will be above the 50% of the week to that week. Okay, there will be a week, you have to put it over there. Your target will be to the entry fair value gap. If the entry fair value gap is very near to your entry, then you can go toward your sell side liquidity. But when it will reach to that entry fair value gap, your stop loss will be to the break even, so that even if market would love to go higher, you won't take any loss, you will be stopped out to the break even. I think until now everything is clear. Oh, by the way, if you get the SMT with mini S&P or Dow, that is the best case scenario. If you don't get it, it's okay. This swing high doesn't need to trade that fair value gap or any other fair value gap around there. Okay, this swing high has no relationship with the fair value gap. In short, this is the first fair value gap rules where you don't need any market structure sheet. Now let me come over here and let me explain whatever I explained over there. Okay. So you see, this is the highest high which has traded the last fair value gap over here. Okay, I don't have any anti fair value gap over here. Instead of that, I have this last fair value gap. So I'm gonna mark it this last fair value gap. I'm gonna mark it as my last fair value gap. This is the highest high. Then market went lower. Lot of swing highs over there. You see, lot of swing highs, and finally, market has traded. excuse, excuse me. Market has taken all of these swing highs. Failed to take that swing high. So this is that extreme swing high which should not be taken. So over here, I'm gonna change the color, and it has traded, or it has taken all of the swing high over here. Okay, so over here every swing high has been taken by body. So this is not called the shallow run because there is a body above all the swing highs. Look, there is not even a single swing high left. If there is a single swing high left, this entry is not valid. After this, you will first look for your first fair value gap. Where is your first fair value gap? Where you will get your first fair value gap, you will take your entry. Okay. Now you can see there is a fair value gap over here. Okay. So this candle low and that candle high. Now I don't want to mark that because it's really so small. I better go for this type of nice clean fair value gap. You know that I go for that. So don't worry, if you are with me in my life, you will get that. Okay, you will get this type of entry, or when I actually look for the first fabric or whatever, you will get that. Now this is not a best example, but yeah, still I'm gonna show it to you. uh, if you are with me in my life, you will get much better example. Okay, over here. So this is the first fair lookup. Market failed to take the highest high, but at the same time it has taken all of these swing highs. All of these highs has been taken. Market went lower. How many candle it takes to break this parallel gap? One, two, three candle. This is the candle which has closed. After closing this, I will take my entry over there. Okay, so I will wait to some kind of higher run. I mean, the best entry you can take very near to that parallel gap. Okay, so I'm gonna put it over here, and my stop loss will be above the 50% of that candle. Where will be your target? Where is your entry favorable gap? This is the part to understand. Okay, where is your exact entry favorable gap? Now if you look at this leg from here to here, you will see no entry favorable gap around that area. There was no entry favorable gap. Okay, so where there is no entry favorable gap, I will go for the first sell side liquidity. You see this low and that low, they are relatively equal lows. So I will go until that sell side liquidity. This will be my, I mean, trade. Now it's look like very bad because I don't like to go for the, how to say, hindsight. So what I actually get from my life, I go for that type of example. So you can see I actually took entry over here. So that was my entry around that area. That area was my entry, and I closed my trade here. Okay, I just closed it over here because it was outside of the session. So it's not a good example, but in short, this is your first favorable gap where you don't need the market structure sheet. You can just observe the price and you can take the entry. I would love to give you another example from here. I believe that it will help you to understand the first favorable gap much better. Okay, so this is the highest high. You can see this is the highest high. Now when market came here, it has taken all the high. Every single high has been taken. Let me mark that here. This is the high which has been taken. Every single high. Okay, by body. I'm gonna change the color over here. Look over here. It has taken all the high by body. See? Now, is this swing high traded any previous entry favorable gap or the last favorable gap? This is the part you have to observe. Now over here, I would love to mark the last favorable gap and the entry favorable gap. So I will mark this one as my last favorable gap, and over here I have this entry favorable gap. So over here, that is my entry favorable gap. Okay. So I am gonna mark it. Just a second. Here. Okay. So that is my entry fair value gap from 1 minute chart. Now market didn't tap to that last fair value gap, so I'm gonna remove the last fair value gap from my chart. I just removed it because market has traded this entry fair value gap. It's enough for me. So this swing high has traded the entry fair value gap. Then it went lower with making so many swing high. You can see lot of swing highs. Then market come back again higher, and finally it has taken all of the highs. Now when all of these highs has been taken, you will start to look for your first fair value gap. Look at this leg. Where is your first fair value gap? I can see this candle low and this candle high. This is my first fair value gap. Okay, price closed below this first fair value gap. You don't need to retrace. I would say you that please trade, take your entry over here. Go and put a stop loss above there. Where should be your target? Now here is the part. This is the entry fair value gap over here. The rules is you have to put a target over here to that entry fair value gap. Now if you put a target over there, it will be near about 500 just. Okay, in this type of situation I actually go for the relatively equal lows or some kind of some other entry fair value gap or lower price action. In this type of situation maybe you can come until the next entry fair value gap or the here. Okay, until here, because below this fair value gap there is no other fair value gap. You can see there is no other fair value gap except this one, except that one. So you can hold your trade until here. That is another example of your first fair value gap entry. And yeah, if you just go and look for this type of first fair value gap entry, you will get a lot of example. But right now I am unable to give you that because I don't like to go previous price action and give you the example. Instead of that, I better go to my live and I will show you the real time example. Okay, that's easier for me to show you the real example or live example. Okay, so if you are interested to join in my live, please join in my live and see this type of precision. I hope that it will build you or it will make you more confident about the first fair value gap entry, where you really don't need any kind of market structure sheet. If you just can understand the price action over here. Oh, by the way, I would love to show you. Here was the SMT. Okay, so there was the actually SMT. This is that high, here high. Okay, so market has the SMT. So here to here, and market actually Nasdaq failed to take that high. So there was the SMT. So if you get the SMT, that is more confidence or better example for taking the first fair value gap entry. So guys, that's all for this video. And if you just keep coming to my live, I will show you more example about the first fair value gap, as I have already shown you a lot of example about the first fair value gap. I will keep showing it to you. But at the same time, if you are new, don't forget to subscribe to my channel. Don't forget to give me a thumbs up. I believe that you will be useful. I mean, my video will be useful for you. So until the next video, cheers.